Lesson 9, Firm Valuation and WACC Weighted Average Cost of Capital. In this lesson, we will learn how to value a company, compute its stock price, and determine the weighted average cost of capital. What is firm value? A firm's value is derived from three key components. First, the operating activity value, denoted as WACC. Second, non-operating assets, denoted as VNOP. And third, debt and liabilities, denoted as D. The firm value formula is firm value equals WACC plus VNOP. That is, the activity value plus non-operating assets. Equity is then calculated as firm value minus total debt. Calculating stock price. The stock price is equal to equity divided by N, where N is the number of shares outstanding. Remember that equity equals WACC plus VNOP minus D. Calculating WACC. The activity value is the present value of all future cash flows from operations. The formula is WACC equals the sum of cash flows at time t, divided by open parenthesis 1 plus k close parenthesis to the power of t, where k is the firm's cost of capital or discount rate. Special case, perpetuity. If the annual cash flow is constant and perpetual, the formula simplifies to WACC equals cash flow divided by k. This is the perpetuity formula we have used in previous lessons. Non-operating assets, or VNOP. These are assets owned by the firm that are not used in its core business operations. Examples include a building rented to a third party, and used land, or financial investments. These are valued at their current market value. Debt and liabilities. This includes all financial obligations of the firm, such as bank loans, bonds issued, and other liabilities. Debt reduces the equity value available for shareholders. Numerical example. Computing firm value. Suppose a firm has an annual net cash flow of 2 million shekels as a perpetuity. It owns a rental building valued at 4 million shekels. It has loans totaling 11 million shekels. The cost of capital is 8%, and there are 600,000 shares. Step 1. Activity value. WACC equals 2 million divided by 0.08, which is 25 million shekels. Step 2. Total firm value. Firm value equals 25 plus 4, which is 29 million shekels. Step 3. Stock price. Equity equals 29 minus 11, which is 18 million shekels. The price per share is 18 million divided by 600,000, which equals 30 shekels. Reverse example, finding cash flow from market data. Suppose a firm has 1 million shares trading at 20 shekels each. Its debt is 8 million shekels and its cost of capital is 10%. Step 1. Equity value. Equity equals 1 million times 20, which is 20 million shekels. Step 2. Firm value. Firm value equals 20 plus 8, which is 28 million shekels. Step 3. Annual cash flow. Cash flow equals WACC times k, which is 28 million times 0.10, resulting in 2.8 million shekels. What is WACC? WACC stands for Weighted Average Cost of Capital. It is the average rate of return the firm must pay to its capital providers. WACC represents the blended cost of all the firm's financing sources, primarily debt and equity. The WACC formula. WACC equals open parenthesis D divided by the sum of D and E close parenthesis times RD, plus open parenthesis E divided by the sum of D and E close parenthesis times RE. Here, D is the market value of debt, E is the market value of equity, RD is the required return on debt, and RE is the required return on equity. Where do the weights come from? Weights are derived from the relative proportion of each funding source. The weight of debt, WD, is D divided by the total value, and the weight of equity, WE, is E divided by the total value. Note that the sum of these weights always equals 1. Numerical example. Computing WACC. Suppose a firm's debt is 60 million shekels with a required return of 8%, and its equity is 40 million shekels with a required return of 16%. Step 1. Calculate weights. WD is 0.6 and WE is 0.4. Step 2. Calculate WACC. WACC equals 0.6 times 8% plus 0.4 times 16%. This equals 4.8% plus 6.4%, which is 11.2%. WACC as the default discount rate. WACC serves as the default cost of capital for the firm. When discounting a firm's cash flows and no project-specific risk information is available, use WACC as the discount rate K. Mean variance criterion formalized. Project A dominates Project B if the expected return of A is greater than or equal to B, and the variance of A is less than or equal to B, with at least one strict inequality. Essentially, higher expected return plus lower risk is preferred. When the mean variance criterion is inconclusive. If one project has a higher expected return but also higher variance, use additional tools like the coefficient of variation, the Sharpe ratio, or the certainty equivalent. Certainty equivalent and risk premium. The certainty equivalent, or CE, is the guaranteed amount equivalent to a risky gamble. The expected cash flow equals the present value times open parenthesis 1 plus K close parenthesis, where K equals the risk-free rate plus the risk premium. Key takeaways. First, firm value equals operating value plus non-operating assets. Second, stock price equals firm value minus debt, divided by the number of shares. Third, WACC is the weighted average of all financing costs and serves as the default discount rate. And finally, the mean variance criterion aims to maximize expected return while minimizing variance.